Welcome back to the Beat the Odds of Business and Wealth podcast, Trevor. We have, I would say, the most important podcast. The most important figure got announced today, and that's the surprising part, right? People think it's the figures that we vote for. It's the elected officials we vote for.
Right.
It's often the officials we don't vote for that make more of a difference.
Yeah, and we've said it multiple times that it doesn't really matter who you vote for, the result always seems to be the same. Whether you call it the uniparty, whether you call it, two wings of the same bird, that doesn't matter. What really matters is the bankers are in control. And Trump's announcement today for his selection for the Fed is consequential to our next. How many years is he going to be in that office? 5 years?
Yeah, four-year term. 4 years as chair, 14 years total.
There you go.
Yeah, 14 years. One of the 7 representatives for 14 years and 4 years in the chair. So let's drill into. I got some things because like how important these people. This is if I just like simple it down crudely. It's like this is the person who comes out 8 times per year and tells the entire world how much their money's worth. Like this is how it's a crazy system that we've come up with, but this is like when you boil it down crudely, like this is exactly what happens. Okay.
You know how ridiculous it just popped into my head. It's almost like every year in Philadelphia or Pennsylvania when they have Punxsutawney Phil, the groundhog come out and say,
yes,
the groundhog says it's going to be 6 more weeks of winter. Same kind of ridiculous idea. It comes out and tells us how much your money's worth. But strangely enough, it affects everything that goes forward from there, right?
And we're going to go, we got a lot of data coming. There's going to be a lot of talking heads, or we're going to go through like real data here. And I'm going to try to give people a real education as opposed to headlines. I want to show them some numbers, some graphs, some charts. So you actually, everywhere else, I think they want to tell you, how to think. I'm going to show you what's going on, and you can make your own decision on how to think. So
that sounds fair.
Your own opinion.
This is an educational podcast, so strap in.
So the first thing some people might say, it's like, well, the U.S. Federal Reserve does not affect Canada. It's like U.S. bonds are our reserve asset, people. Like, right. We don't have any gold. We do not have any gold. And I pull up on here. This is from the Bank of Canada website. It actually shows our reserves. Okay, so our reserves, and this is in millions of dollars. So 68 billion U.S. dollars. Okay, we have 30 billion of other foreign currencies. And then we have 23 billion of special drawing rights and 4 billion of reserve position IMF.
Wait one cotton picking second. Look at how much gold reserves Canada has.
Zero.
That is more scary than anything else in this particular climate. But hey,
and special drawing rights, if you could just rename it, these are IMF bucks. So. These are International Monetary Fund bucks. Like, this is what they are. They're a basket of currency, which is also majority U.S. dollars. Like, yes. That's in effect, right? And so this here is straight up. And when they say U.S. dollars, they're not just sitting around holding cash. They're holding U.S. treasuries or U.S. bonds earning a return, okay? So, so 68 billion is directly in U.S. bonds, okay? 23 billion is in special drawing rights, which is effectively a basket of currencies, mostly U.S. dollars. Okay, so out of the $128 billion in reserve assets that we have, let's call it 90 billion is U.S. dollars. This is our reserve asset, people. Mm-hmm. This is the interconnectivity of the system. Okay. It goes beyond that. It's not just what our reserves are. It's like what the interest rates. We're not going to have 1% interest rates here and 10% in the U.S. It's not going to work that way.
Right. Okay. And people also have to remember that when it comes to currencies, right? We're always measuring our currency against the U.S. dollar.
Yes.
So anybody who is trading back and forth, if we're selling goods into the U.S. or if we're buying goods, it's all transacted at that differential between the U.S. and Canadian dollars. So for people in Canada who manufacture goods here and sell them into the U.S., of course they make that 30% bump sans tariffs. But,
Yeah.
So it does matter what happens with the Federal Reserve.
Exactly. And so I'm going to go straight first. I'm going to, look at on the U.S. end, what is happening in terms of the U.S. charts. Then I'm going to tie that back into, how that affects what happens in Canada. Then we're going to finish on what I think maybe you should do about it.
All right. Let's do it.
So, the first of all, what did the gold market think of Kevin Warsh? What did the gold market? Remember, we had an all-time high of $5,600 per ounce, right? Oh. $5,600 per ounce. So I remember sitting here.
How many snow pesos is that?
Yeah, like I was sitting here, yesterday, the day before, looking at this at 7,000 Canadian dollars at the beginning of the day, thinking it was 7,500 Canadian dollars at the end of the day.
Holy moly.
It's just wild. This is an ounce of gold that I used to buy for 2,000 Canadian dollars, right? So the gold market sold off. Now, a lot of this is just like, was it just overbought and it's just a natural pullback? Sure. But like some of it is, it's Kevin Warsh, right? Because there were other alternatives there. There were other alternatives out there who were more, I don't know if dovish is the word, but it's more just like that they're just going to print till their eyes bleed, like the cartoon character who's printing the money, right? Like there were some other kind of real wild ones out there, and I really think that this had the lead up to the gold prices because people are like, oh my goodness, if these guys are in charge, like they're just going to print this thing into oblivion, okay? Kevin Warsh is going to do something a little bit different, and one, a solution that I don't think has been like well talked about, because it's pretty much like, let's be a hawk and not, let's be a hawk and raise interest rates and shrink the balance sheet of the Federal Reserve, or let's be a dove and lower interest rates and expand the balance sheet of the Federal Reserve, right? But Kevin Warsh is different. He wants to push one of those levers in one direction, and he wants to pull the other lever in the other direction. That's interesting. It's unique, okay? And I want to explain that to people, okay? So but also the Bitcoin market also didn't like Kevin Warsh. They wanted one of these BlackRock guys. They wanted the BlackRock guy to come in here and just expand the balance sheet and lower the rates and like let's cause the chaos. And let's cause $1 million Bitcoin tomorrow. Let's cause $10,000 ounces of gold, $1 million Bitcoin tomorrow. Like here's where we're going, right? But that didn't happen. Okay, so overall, in the short term, the gold market and the Bitcoin market reacted negatively to this Federal Reserve appointment. Okay, but he's not really a dove and he's not really a hawk. Okay, there's a lot of nuance to this, and it's very important to understand. So, what is the Federal Reserve balance sheet? So this is the Federal Reserve balance sheet for approximately the last 10 years. Okay, and actually this goes all the way back to 2008, and you can see the massive expansion of the Federal Reserve balance sheet from let's call it $4 trillion to all the way up here to $9 trillion, and finally we've normalized somewhere around $6.5 trillion. Okay, so what did that expansion of the balance sheet do when the Federal Reserve creates new money with a click of a button and goes out and spends that money primarily on bonds? That money gets injected into the system. Those bonds come back to the Federal Reserve, okay? What that does is increase the money supply. And so here is the money supply in the last 10 years. It goes from $12 trillion, okay, all the way up in the U.S. to $22 trillion, okay? Double the money supply. Double the money supply in 10 years. Now, did the population double? No. Does that look like a 2% growth rate, what they tell us what the inflation is? No. You start to calculate this, you start to get the real inflation of like what it actually feels like when you go out and purchase goods and services, and certainly desirable assets, where most of the excess cash flow ends up going, because the people with money don't go buy, 4 steaks for dinner every night. They buy 1 steak for dinner every night, and the excess cash goes to desirable assets. Yes. And so that's what happened, so that expansion of the balance sheet, okay, is what happened. Okay, now, why does that balance sheet need to expand? It's like, what is happening here? Governments aren't going to balance their budgets. Okay. The U.S. government, $1.7 trillion deficit. Okay. This $372 billion in tariff revenue. Hopefully, if it doesn't get struck down by the Supreme Court, maybe that's coming to the coffers. Maybe it's not, right? 2 trillion, 1.7 trillion. Okay. People aren't ready for a balanced budget. They're just not ready for that discussion. This is not a question of who you vote for. This is a question of the people voting for the people.
Right. Because they always vote for the people who want to give you free stuff.
They're not.
They're going to give you free things. We're going to make life better for you. We're going to pay for this and pay for that. And they vote for it, but they don't realize the consequences of their actions. And the other distraction that we see are the people who are hawks and they want to, have a balanced budget. We want to reduce the amount of spending that we're doing, that putting the burden on the taxpayers and their children for generation after generation. So those guys, they get their group of people who are on them and they're like, yeah, we're supporting that. That's amazing, because you think of a household budget, a balanced budget, like otherwise you're not going to go bankrupt. You're going to be able to feed your kids. So they're thinking it in the same terms, but really in reality, if we did that, it would ruin everything.
Yeah, like the people aren't ready for the solutions. No. Even the people who talk about balanced budgets don't actually mean balanced budgets. They just like talking about balanced budgets.
No
because
Social Security.
They just don't want to talk about, like, this is the Western world where like the balanced budget is only possible if you start, having serious discussions about healthcare, seniors benefits, military spending. And once you start talking about that, you become a political pariah. You don't get elected. It doesn't matter if you're Donald Trump or Kamala Harris or Mark Carney or Pierre Poilievre. It's like they'll talk about fiscal responsibility, but they won't talk about the issues where you could actually be fiscally responsible. They'll talk about tertiary efficiencies that seem fiscally responsible, but are smaller, much smaller line items in the budget, which don't make it possible. Right?
Case in point, right now they're talking about all of the fraud that they're uncovering in, where is that? Minnesota, right?
Sure.
Talking about all of that.
If they shut down all the Somali daycares in Minnesota, we're going to balance the budget. They're going to balance the budget. Like, it's like, should they shut down fraudulent daycares?
Of course.
Yes. Is it going to be material in the 1.7 trillion? No. Like, it's just not, right? Like, is there other elements of waste out there? Yes. Is there some people out there who are 120 years old still collecting Social Security? Yes. Is there enough of them to make the Social Security number to go down from 1.6 trillion even to 1.5 trillion? No. Like, it's just the materiality of the amount. And so, like, it has an upper limit in terms of the fraud and waste. Eventually, if you really wanted fiscal responsibility, you have to make really tough choices, not just the ones that sound. It's easy to try to convince people that it's all fraud and waste. The whole thing is fraud and waste. Like, no, some of it is programs that the taxpayer, the electorate actually wants. They probably shouldn't want because they're just paying through inflation, right? But they're not ready for that. They're not ready for that. Okay.
$35 veggie trays have to, they pay for something, folks, right?
Yeah, think it's free. It's not free. You're just paying with the devaluation of your currency and wages. So, okay. So what does the Federal Reserve get to decide this? Okay, the Federal Reserve gets to decide the expansion or the contraction of the balance sheet. There's basically like three roles of central banks. They can expand or contract the balance sheet. They can raise or lower short-term interest rates, and they can change bank and lending rules. These are like the three tools. They talk about all the tools and the tools. There's three. A hammer, a screwdriver,
pliers.
Like, that's it. They got these three tools, and we're going to make it like overly complex and confuse everybody, because if you told them simply, they might start rioting in the streets, right? But so, like, these are the three tools in the tool chest that they have. Okay, and people say, like, well, like, the common one is like, well, they don't affect the long-term bond rates. The bond rates is set by the market, except for the fact that they can print fake money, go out in the market and buy long-term bonds. People like that they do affect the long-term bond rates, because, like, if they had no balance sheet, sure, that might be the case, right? But if the balance sheet includes long-term bonds, you 100% can affect the rate, right? If you got, $6 trillion at your disposal to go out and buy long-term bonds, you better believe you can affect those long-term bond rates, right?
Yeah, for sure.
That's a lot of money, right? And so here's where we are, where this is, what people have been thinking is that there's going to be a Federal Reserve individual in there who is going to be contracting the balance sheet and simultaneously increasing the short-term borrowing rates, okay? The hawkish stance, or the dovish stance is I'm going to be increasing the size of the balance sheet, so injecting cash flow into the system and lowering the short-term interest rates to make it easy to borrow, okay? Kevin Warsh is different. Kevin Warsh is, I want to, I'm not sold that he wants to materially shrink the size of the Federal Reserve balance sheet. He's talked about it, but I think he votes for prudence. He did not want to see the size of the Federal Reserve balance sheet go from $4 trillion to right here $9 trillion. Mm-hmm. You know what I mean? He thought that was irresponsible, right? So whether he wants to shrink it or maintain it the same, he wants to be hawkish in that he wants to control the size of the Federal Reserve balance sheet. But he's dovish in the fact that he wants to lower short-term interest rates, okay? And so that's, you basically have two levers pulling in different directions, right? And what effect is that going to have? So the short-term interest rates is pretty easy to understand. So that short-term interest rate in the U.S. right now is, 3.75%. They have their range or whatever. Let's call it 3.75%. So he wants that lower, okay? And simultaneously, this balance sheet, he's going to keep it the same or shrink it, or prudent growth, maybe, right? Mm-hmm. But it, he does not want this explosion. That's what he was critical of. Okay, now
I did have a question about that. Just popped into my head here. When it comes to that where he wants to maintain the balance sheet where it's at. What about places like Japan and others that are selling off their bonds? How does that? Because the Fed has to buy those. So wouldn't that increase the balance sheet, or am I misunderstanding something?
If Japan's rates go up, you have capital flee the U.S. system to go repatriate to Japan. So it exerts downward pressure on the U.S. stock market and the U.S. bond market. So it's not just bonds; it's also the stock market. Because if you can borrow cheap money in Japan and invest overseas at better rates, it's like there's the carry trade, right?
Yeah.
So that does it affects it. It does affect it, right? And Japan is the largest holder of U.S. treasuries. But I also want to put this in perspective too. So I think Japan might have dropped below $1 trillion, in U.S. treasuries. Okay, but this next chart I'm going to show, it might grasp some, materiality to how much that means, right? Because the numbers in the details, and I think when you start stripping away all the crazy amounts of zeros after the numbers, it starts to become kind of simple. So Japan has $1 trillion of U.S. treasuries. Okay. Let's say if they sold off a U.S. $1 trillion. Okay. Where does it have to go? Straight on the Federal Reserve balance sheet. So that might be the quick rational thinking. But I want to show this next chart. So this next chart is very, very important. Okay. This is the total money market funds in the U.S. The money market funds have increased from $3 trillion to, let's call it $8 trillion. Okay. So from $3 trillion to $8 trillion, primarily in the last 5 or 6 years. Okay, now why would people put money in short-term money market funds? It's because of this here. It's tied to this. If interest rates, short-term interest rates set by the Federal Reserve are zero, the motivation to put money in a money market fund earning zero is nothing.
Right.
Okay. If short-term interest rates set by the Federal Reserve is high, all of a sudden I have, an ability to get a predictable yield, and I don't have the risk that goes with long-term bonds. Okay, because when you have bonds, you have two risks. There's two risks when it comes to bonds. It's the issuer risk. Is the issuer going to default on the payment? Okay, so theoretically, if it's the issuer is the government, okay, whether it's the federal, whether it's the U.S. government or whether it's the Canadian government, they don't really have an issuer risk because they can print the money to pay you back. Okay, but the second risk, it's not a default risk; it's duration risk. Okay, if you have a long duration product, if interest rates change a little bit, the value of that bond is a lot because the value change of price of that bond is a lot because the duration between when you make the investment and get your face value back is a long time in the future. Whereas a short-term product, if the desirability of that interest rate changes over time, it's not a big deal because you're getting paid back in 30 days, 90 days. It's not a big deal, okay? So this becomes a very predictable way. That's why with this short-term rate high, that's why a lot of capital has flown in to money market funds, okay? And this is a little bit like money market funds are... they're kind of part of M2 money supply and kind of not part of M2 money supply. So you see the M2 money supply going from 12 trillion to 22 trillion. So the kind of the plumbing behind the money market funds is basically these money market funds that are owned by retail investors and small businesses, small corporations. They're actually included. They're part of the 22 trillion, whereas money market funds owned by institutional investors are actually not part of the M2 money supply. Okay, so I believe approximately 30-40% of this 8 trillion, so let's call it 3 trillion of the 8 trillion, is already part of the 22 trillion. It's part of the same number. Okay, but with $8 trillion here, $8 trillion, who currently today, at fair market, whether you agree with it or I agree with it or not, has decided that they're going to put that, $8 trillion to work and have no duration risk because this is short-term products in exchange for, let's call it 3-4%. Let's call it 3%. Okay, and that's not just a U.S. thing. That's globally. Like we have money market funds in Canada. There's money market funds in Europe. Yeah. Okay, so they've decided that that's the best use of their capital. Okay, now if short-term rates come down, there's no expectation that that same number of people will keep those money in money market funds.
Right.
Okay.
So it's got that capital will flee. It's got to go to a more desirable
something else that pays a higher rate of return. Right. So the problem is that the U.S. Ultimately, when you're a politician, you're kind of a bond salesman. I'm just going to boil them all down. It's like effectively they're bond salesmen because they don't want to balance the budget. Balancing a budget is a basically political suicide, and that's not a Republican Democrat issue. That's not a conservative liberal issue. It's the electorate has not made the decision to, they actually want these choices. The viewers of this show might want those choices, but I guarantee you that 99% of the population is not ready for these choices yet, right? They're not ready. Someday they will be. Yeah. Someday they will realize that they were never getting anything from free, but it's not going to be tomorrow, right?
/ Social Security. Get rid of the healthcare spending.
Oh yeah,
military budgets.
Yeah, like this is not functional, right?
Their heads would explode.
Yeah. So there are free Canadian healthcare. It's free to go and sit in the waiting room and die, basically. Like that's the it's free though. But
or you can take the fast track and just get mated out of existence, right?
Yeah, but it's free, right?
It's free. That's right.
Okay, so this here, like they have to protect the long-term bonds, and like this is the point where people say, yeah, the market decides the long-term bonds rate. Yes, initially, but remember, the Federal Reserve can come back in, and if basically these yields climb too high, so when they climb higher, it means the price of the bond goes down. They're less desirable. So instead of buying a bond for $1,000 face value, if I buy it at a discount for $950, my effective yield goes up, right? And yes, the Federal Reserve does not set, they don't go out and, just authoritarian say what the long-term bond rate is, but they have the bazooka to step in and alter the market to what they want it to be.
They can just print the money to adjust the value.
They can print the money. They can go and buy. They can create basically an unlimited bid for those bonds and drive the price of the bonds up and the yield down, or they can sell it off, in which case the price of the bond, long-term bonds, goes down, the yield goes up. Okay. So hopefully we're good on that. Like there'll still be someone in the comments that says that they don't control the market. It's like, I know they don't control the market, but they're the biggest buyer and affect the price, right?
That's right. Yeah.
It's like that's how it works. And so, going back to the Japan thing, it's like, how significant, and people talk about that carry trade. Mm-hmm. They got $1 trillion. There's $8 trillion of capital in short-term money market funds, just in the U.S. Just in the U.S. If Warsh executes his position and lowers rates, like, the money's coming out of here. All of it? No. I mean, there was $3 trillion before when interest rates were, closer to zero, right? Or much lower. Okay. So, let's call it, there's $4 or $5 trillion of capital. If rates come down, that it's going somewhere else. And so that's 4 to 5 times Japan. Okay. And this is not, this might be the largest money market fund in the US, but it's not the only one.
Mm-hmm. Right.
There's lots of capital tied up in short duration instruments right now because of the short-term rates are high. So the idea is that if they can lower short-term rates, okay, they will have a bid for these bond prices. Okay, so they'll be able to, get this interest expense down, because this is going to climb to over $1 trillion, just rolling over $38 trillion.
Oh, yeah, they've got a warning label right there, a little warning sign right beside the interest on the debt.
Yeah, the nuclear bomb warning, right? Like, eventually we head towards where this interest on long-term debt is the same as the tax revenue collected, and that's when it's over, right? But we're a long ways away from that, But
we're one war away.
Oh, yeah.
Just speculating, folks.
Hopefully,
I'm just making stuff up.
Hopefully not. Hopefully they avoid nuclear war before they gets there. Hopefully, and so this interest on long-term debt, just to roll this over, to roll $40 trillion over at 4%, like, this goes to 1.6. Okay, it goes to 1.6 trillion, right? So I tell people, just simple math, get rid of the zeros, like 40 trillion, 4%, 1.6. That's a problem, because you're already at a deficit of 1.7. Your deficit is at 1.7 of a GDP of 31, right? Like that you're not growing the economy by the same speed that you're growing the debt. Okay. No, the robots aren't coming in and magically going to grow it that way. Like, that sounds great, right? The universal high income, mm-hmm. right? Yeah, I mean, that guy's trying to sell something too. He's got some robots to sell you. So,
well, money has to there has to be transaction. It has to be fluid and flowing. It can't just stay stagnant and go nowhere.
Yes.
Otherwise, this all shuts down.
Yes.
So there has to be liquidity in the pockets of everybody. So they're buying the stuff. They're buying the cell phone plans. They're buying the new iPads. They're buying the electric vehicles, or they're buying groceries and stuff. So if that isn't flowing, then the big companies who really benefit from it, the large asset management, then this whole contraption falls apart.
Yes.
So they have to be manipulating it. There has to be, liquidity, moments of high liquidity and low liquidity to try and gauge and control what happens, right?
I mean, yeah. I mean, the would there be natural ups and downs in the market? According to the Austrians, yes, and the Keynesians would tell you the government needs to be in control of that, right? So, I would suggest, if you study history, that the market was actually much more stable before the Keynesians got involved. People think that money just started with central banks. It's like there was private currencies issued for hundreds of years before the Keynesians came along and
for
hijacked
sure.
it, right? So
Yeah, absolutely. I mean, I'm still a fan of solid money,
Yeah.
like, with the real stuff, the gold, and in the future, Bitcoin being a good reserve currency.
Yeah.
But at the moment, we have the fake money to play with, so we gotta live as the world is, not as we wished it would be.
So I think, like, in absence of political will to actually make the tough choices, like in the short term, it's like, yeah, you have this capital here, and a lot of this capital in the money market funds, let's call it 5 trillion of the 8, is just institutional capital. This is the part where they start to say, it's like, yeah, this is really not benefiting Main Street. This is benefiting Wall Street. It's like, yeah, it's actually kind of true, because 5 of that 8 trillion is not owned by Main Street. It's owned by Wall Street. Okay.
Yes.
And so they're benefiting from this rate, which they basically have no volatility risk at all. They're just getting a return without any volatility. Okay. And who's it paid for? By the U.S. government and the taxpayer. It's the same. It's the same in Canada, right?
Basically, it's parked money waiting there to invest in something better that comes along. Is that a decent explanation of why people invest in money market funds?
Yes, and they haven't been forced thus far because short-term rates have stayed relatively elevated.
Yeah, so they're getting a decent return, decent enough.
So,
I mean, it doesn't keep pace with inflation.
Yeah.
But at least it's not completely evaporating or being stale.
So if you're a politician and if you remove the TDS syndrome out of this equation, and you're just like, I got 3 more years of my term,
Right.
and I know that no one's ready for any hard choices here. So how do I continue the Ponzi? How do I continue to spend more than I take in? And how do I not let the long-term bond market blow up, that it goes to the moon or the Federal Reserve has to buy all of it? What I do is I force this out. I force some of this $8 trillion. Maybe I force 4 trillion of this 8 out and get it down to 4. I make it not attractive to do it.
Right. So they would do that by reducing the interest rate.
Reducing the short-term interest rates, which then it starts to make it possible that, yes, you could reduce the short-term interest rate, and you could shift some of the government debt to more short-term products to reduce the interest expense of the government, and you could simultaneously keep the size of the federal balance sheet under control without blowing up the bond market for at least 3 years.
Until the next election cycle,
with $4
right?
trillion, right? Because you got $4 trillion parked there. So it's, in the land of bad decisions, maybe it's the best bad decision that's available to a politician right now, right? And so that's kind of what the plan is, right? That money is going to come out of short duration products, right? And we use them here too. We're managing corporate treasuries, and we're very happy to get our 3%.
Yeah.
We're happy, because managing corporate treasuries, 10 years ago, we had to tell them, we want to slowly deploy money capital, but we want to do it slowly, prudently over 24 months, right? And money managers at the big banks love to not do that because they get a commission to deploy everything tomorrow. But
let's say you have 200,000. We're going to invest all 200,000
tomorrow, because this is the day. It just happened to be the day you came in to inquire about my services, and we're going to deploy it all tomorrow, right? And that's how it works, right?
And I've got a deposit on a boat.
And I get a commission only if you deploy it. So that's kind of how the whole thing works, right? But corporations, CFOs like me, don't think like that because we get paid flat rates to make sure the thing doesn't blow up over time, right? That's kind of our goal, right? And then we increase net worth over time, not earn a bigger commission tomorrow. I don't get paid to move a corporation's balance sheet into a specific product tomorrow. I get paid to make sure that it doesn't blow up tomorrow, and we increase net worth over time.
Prudent decisions, not commission based.
And this is how families need to think about their balance sheet, but they don't yet. But that's why we're here. That's why we're doing this thing, right? So
and it becomes increasingly more difficult to control and manage money as that balance increases. As the amount of liquid increases, you have to do something with it. Otherwise, it's going to be inflated away or stolen by taxation. So you got to deploy it somehow and do it prudently.
Yes. Okay. What happened to the Canadian currency?
Oh, let's check.
Hey, we bounced off the 70 cents in the dollar. Maybe we're a little lower than 70 cents in the dollar. I actually think that's the the red line. I think the Bank of Canada has decided that's the point where they're going to intervene, and they're going to use some of those FX reserves to deploy. You start to look at the 10-year history. You start to see it's like if it gets below 70, it doesn't last for long, despite if there's no fundamentals to move it back, right? Yeah. So that tends to be that band between, we call it 70 and 80 cents on the dollar, okay? And so they can deploy reserves to create the bid for the Canadian dollars, right? Or they can issue more currency if you get too far beyond 80, because the wisdom, and it's not wisdom, but it's just the theory. It's just that the only way to sell products is to have a cheap currency. But that's just
it's the bargain basement pricing that just makes me
race
crazy.
To the bottom.
So it makes me crazy about Canada and politicians and their thoughts of what we are. Like, they wonder why Canadians have an inferiority complex, but they feel superior to the U.S. It's like, guys, wake up. Remember the good old days. Remember when, I'm going to say the H word, Harper was in the Prime Minister's office, and we were actually like on par and above the US dollar for a period of time.
He was too boring. His socks were one color.
Bro, right? I know. He wasn't popular enough. He had boring hair.
He was boring.
I would prefer a boring economist running ththings than Mr. Flamboyant Fancy Socks. I'm sorry.
I'm sorry. We just look at Poilievre, look at Carney, look at Trump, look at Harris, look at Biden. It's like, oh my God, it's a guy like Harper is like just a boring economist. They're just going to put him in charge. He's like the exact opposite of anything that exists in Ottawa or Washington now, right? Like it's just like they're all just like, it's like Hollywood for ugly people. Like it's
exactly. It's a complete clown show.
Yeah.
All right, what do we got next year?
Okay, so that's the Canadian dollar.
Yep.
Standing pat, pretty good.
Yep.
Okay. Now a lot of oil price. We were,
sure,
$65 a barrel now, and we were, not too long ago, flirting with $50 a barrel.
Yeah.
Okay, so that's a big deal. Okay, this is the Canadian short-term interest rates. Okay, we are down to 2.25, and I hear people say like, "Oh, that's neutral." It's above average for the last decade or two. Okay. With the average being maybe closer to 2. Like, we're close to the average, but people say it's like it's towards the lower end of the neutral. It's like, I know that's what it said in the Bank of Canada report, but that's not what the history suggests. If you go back and look at the charts, that's, a little higher than average. Okay. But at the same time, it's like if the U.S. is paying a 3.75, if you're getting, 3-4 points in a U.S. money market fund, and you're getting 2 or 3 points in a Canadian money market fund, that's why you have downward pressure on the Canadian dollar. Okay, that's just why you have downward pressure on the Canadian dollar. So you can't get too disconnected on that. So a lot of people, out there saying, the same people who think you can solve a tariff war by pouring out a little bit of liquor might say that you could just drop rates and nothing would happen, but something would happen, people. Like, that's not how it works. The same people say that the Bank of Canada and the Federal Reserve doesn't have any control over interest rates think that you can just drop interest rates and you can also control the currency exchange. Like, that's not how.
Oh my gosh!
Either,
how much Crown Royal do you think people buy? Yeah. Like, honestly, oh my gosh! Like, what a foolish decision by Rob Ford. Gimli, Manitoba, Crown Royal, been made there for forever. Yeah. Anybody. So this is not we don't get paid. This is not a paid promotion, but buy more Crown Royal. I don't care where it gets bottled. It's called efficiencies and economies of scale. They got to do what they got to do. Buy more Crown Royal and give Doug Ford the old. That's all I got to say about that.
If nothing else, after a few glasses, you'll stop worrying about all the currency. Okay. Now, this is the Canadian 10-year bond yield. I know in Canada, the 5-year bond yield is more inducive to the mortgage rates because we do our mortgages every 5 years. Most Canadian mortgages are 5-year terms, and the U.S. is on 30-year terms. But
50.
I wanted an apples to apples here. Sure. I'll show you the 5-year one in a bit. But okay, we're at 3.4%. So remember, on U.S. long-term bonds, we're talking 4.2%. Okay, so
It's
on
like a point.
U.S. short-term, okay, they're 3.75. Okay, long-term on 10-year, they're 4.25. It's like only an extra half. This is why so much money is in U.S. short-term money markets, because you're only getting a half a point difference to take on the duration risk. You're only getting a half a point difference before, someone goes and drops a bomb on Iran one night and all of a sudden your bonds are worth 10 or 20% less. And you did that all for, half a point difference.
Yeah, so that makes a lot of sense why you'd go into the money market funds.
That's right.
Uh-huh.
You don't want to take that duration
on this
risk.
chart,
Yes.
the dollar comparison. So it says here the U.S. 10-year Treasury note is 4.25, and is that a percentage?
That's a percentage.
Based on U.S. currency?
U.S. currency. Yeah.
Okay.
I put in $1,000 and I buy $1,000 of U.S. bonds. I'm getting a 4.25% effective yield.
And then for the Canadian one, is that measured in U.S. dollars too, just so apples to apples comparison?
I mean,
or is that
it's Canadian. Yeah, it's Canadian. Like generally, you purchase U.S. bonds in U.S. dollars and Canadian bonds in Canadian dollars. That's just how you would purchase the instrument.
Sure.
But you could convert the currency first and then get the other rate, right?
So really, the Canadian 10-year bond is like way worse in comparison because it's already 30% less.
Yes, but if you had obligations in Canadian dollars, in order to benefit from that risk, you have to expose yourself to the currency risk, right? So like if you had significant obligations and you did that at 70 cents because you were getting an extra, an extra percent, all of a sudden when the Canadian dollar goes from 70 cents to 74 cents, now all of a sudden you're offside.
Yeah.
So if you're dealing with huge obligations, there's an arbitrage there, but there's a risk that goes with that arbitrage, right? Depending on what you're trying to offset for. Okay, so that's the 10-year. I'll show people the 5-year too, because that's not as the U.S. 5 years not commonly, it's not like the common benchmark. The benchmark for the world is a U.S. 10-year bond, right? And so I want to show the U.S. 10-year versus the Canada 10-year. But it's important to understand as Canadians what the 5 years, because it generally, affects, 5-year fixed mortgage rates significantly. Okay. Right? You start looking at that. It's 3%. Okay. Let's review. We have U.S. short-term, 3.75. U.S. 10-year, 4.25. Okay. We have Canada short-term, 2.25. Canada 10-year, 3.4, okay? And Canada short-term, let's call it 3, okay? Okay, that's where we are. And so now we know what's going to happen is we know what they say. We don't always know what they're going to do. But if he does what he says, he wants to control the size of the balance sheet and basically extract the liquidity from the short-term market. That liquidity is going to go not just into the bond market. Like it's not necessarily going from short-term money market funds to long-term bonds. It's going to go everywhere. It's going to go into private businesses. It's going to go into real estate. It's going to go in the stock market. It's going to go into gold. It's going to go into Bitcoin. It's going to go, right? It's going everywhere, but some of it's going to go to long-term bonds. Some of it is like I wanted long-term bonds are more, long-term bonds pay higher, but they have more volatility than short-term bonds, right? But someone will say, but they got less volatility than the stock market, so I'm going to take it, right? But they're just not taking it now because, if I'm getting 3% for no volatility and 4% for volatility, I'm going to take, a lot of people are going to take the 3%. But once they're getting 1% or 0.5% for no volatility versus the 4%, that motivation starts to go away and that capital will flee.
Okay.
Gotcha. Okay. So what is going to happen? How does that relate back to Canada? It's like we're probably going to continue to see downward trend. So I think like the variable rate mortgage, okay, there's always risk with variable rate mortgage. There's a lot of statistical evidence that says there's no 25-year period where you would have did better fixed than variable, okay? Everyone thinks that they can project the market at any given time, but they forget that their mortgages don't come up when it's obvious to predict. It comes up on a 5-year schedule. A lot of times you got to pay a penalty to change that schedule, okay? But you would think that short-term interest rates are at least going to stay where they are, and potentially go down even further. Because I think one of the limiters that the Bank of Canada has had in reducing short-term interest rates further, it's not because of our glorious economy that's pumping out. It's not because of that. It's just because of currency destruction. It's just because if the U.S. government has their short-term rates at 3.25%, we got our short-term rates to 2.25%, and we flirted with 69 cents on the dollar. Have a little bit of a reprieve recently because oil's gone from $50 to $65 a barrel, but oil's not going to go up by $15 a barrel every couple of months.
No. So that difference
Hopefully.
so that 1 point difference between the U.S. and Canada interest rates makes a big difference for us. So it puts downward pressure on the Canadian dollar because of that.
Mm-hmm. And Warsh said he wants to shrink that. So he wants to lower short-term interest rates. Mm-hmm. He has a plan, which I think is it's a viable plan to try to control the bond market. We don't really know what the plan that he's saying. It's not like that plan has been done 10 or 20 times before. In fact, it's never been done at this scale. Like we've never tried to, they've never tried to unwind $8 trillion in the money market fund into other assets. Like for all we know, none of it goes to the bond market and it all goes to the stock market. Like I don't think that's the case. Like it's never all or none, but no one really knows what percentage is going to go where. We're in uncharted territory, but it's a viable plan, at least in the medium term. I say medium, like the kind of the 1 to 10 years. That'll have some legs, right? And that's where that liquidity is going to come down. So basically, as that 3.25 on the U.S. side gets closer to the Canada side, 2.25, certainly it removes the motivation to increase the 2.25 short-term rate and gives the Bank of Canada more freedom to reduce it even further, right? In terms of long-term rates, I would suggest that they're probably not going to go as far as people may want them to go. So if you were looking for your some more confidence, you never have full confidence, but if you're looking for more confidence that your variable rate is going to kind of stay where it is or go lower, you probably have it. If you're hoping for your long-term rate to go from 4 to 2, that doesn't seem without some sort of geopolitical event or crash or something like that. There's nothing on the horizon for that, right? I think the goal in the U.S. is I think they're comfortable between 4 and 5% on the 10-year. I think they've decided that between 4 and 5 on the 10-year is good. I think they decided that at 5% stuff starts to break, like Silicon Bank and that happened, right? But I think between 4 and 5, I think they've decided that's kind of neutral territory. And I don't think it's fair. I mean, I don't think it's inflation. You're expanding the M2 money supply by 8%. I don't think it's a good investment. But there's enough people who do think it's a good investment for it to work, and then there's other people who have to buy it. They're insurers, pension funds, who just for regulatory reasons, banks, they have to buy that asset.
It's got to be on the balance sheet.
Has to be, and then they got a matching principle based on their obligations. So they're kind of forced into it, and even some of them don't like it, right? I bring up one of our clients who's a CFA, he's a chartered financial analyst, and he did fixed income products for big municipalities for years, right? And what does he not own? Bonds. Even though he's a specialist in bonds, he wouldn't buy it for his own portfolio, but he knows when and what to buy it if you're buying it for an institutional portfolio.
Because it's the risk-free investment, right?
I think it's return-free risk is what I like to call it. Return-free risk, right? So I think if that's what you're looking for in Canada, I think you probably got some more confidence on variable rates now. But you probably, the optimism on fixed rates on 5-year terms is different, right? I think on the U.S. side, it's like you get these like cultural differences and people just do different things in different jurisdictions just because it's the way it's always been done. But that means on the U.S. side, there's probably not much reprieve if you want to do a 30 or now 50-year fixed rate mortgage.
Right.
But the the variance between the variable rate mortgage, which are way less popular in the U.S. than Canada, and the fixed rate mortgage is going to get bigger and bigger, and the motivation to push people towards those variable rate products is going to be more.
Mm-hmm.
Okay.
Yeah.
So the variable rates are coming down on both sides of the border. It's just in Canada they're used more frequently.
Yeah, it's simply because of our real estate mortgage laws, or mortgage rules, I guess, and the way that we have to renew every 3 to 5 years. 1, 2, 3, or 5 years. Yeah.
Yeah, I mean that's just what we've done, and people just tend to do what's been done, regardless if it makes sense or not. So, but I think you'll get a couple people off in the U.S. who'll be like, yeah, okay, my variable rate was 5% and my fixed rate is 6%. I'm going fixed, right? My variable rate or my fixed rate is these days like 7%. You know what I mean? Like, wow. But what happens when that fixed rate is 7% and that variable rate is 3%?
Oh, people will jump.
The motivation is going to get bigger, and they won't all do it because they have the flashbacks of 2008 and stuff like that. But I tell people it's like, people act like variable rates are the single biggest risk. It's all about ratios. It's all about income. It's like, I told everybody during, when rates came up after COVID that we weren't going back to 20%. We're not going back to 20% because the U.S. government has $40 trillion in debt and they can't afford to pay 20%. Like, it has 3 times as much. There's 3 times as much debt in the system as when in the 80s when interest rates did go up to 20%. So the 7% interest rates that we saw this time around were just as stressful as the 21% interest rates you saw in the 80s because there's 3 times as much debt.
That's right.
That's it. There's just an upper limit to that.
And the deflation of the dollar, or the inflation rather, like, a house in 1980, we're looking at a decent house in Edmonton, $80,000 to $100,000, right, all in. So you get 20% interest rate. Okay, here you have houses starting at $350,000 to $500,000.
Yes,
at 7%, hurts. Hurts a lot.
The multiplier between the median income and the house price is grown, right? So even the ability to put cash down is smaller. Like, it has to be a greater percentage of the house. Is generally going to be financed because the house is larger comparatively to the income. So the rates matter even more.
Oh, for sure.
Right. So I think that's, we're addicted with real estate in Canada. So I've just told you my long-term, my medium-term prognosis of, interest rates, mortgages in Canada. But I encourage you to get off of the addiction of real estate and look beyond to other financial instruments of what's happening. How many Canadians don't own 1 ounce of gold? They do not own 1 ounce of gold, right? Yeah. Despite all the craziness, they'll complain about governments never balancing budgets, but they'll never have anything that's not denominated in either, directly tied to Canadian dollars with a massive deficit or U.S. dollars of a government running massive deficits, right? They don't buy anything else, okay? I want to show you something here, and this is a clip directly from Warsh himself, okay? This is a clip directly from Warsh himself. We're going to watch it. It's a couple minutes long. I think it's important. You need to see this. This is the guy who comes out and tells everybody how much their money is worth 8 times per year, including you Canadians. Yes, because all of our reserves are, tied up in U.S. dollars. Like our interest rates are directly correlated to U.S. interest rates. You need to see what this guy said before he became the center of, political attention. Okay.
All right. Punxsutawney Phil, here we go. What's he say?
You made reference to Bitcoin, and I thought I heard a little bit of condescension that people are buying Bitcoin and these things.
But doesn't it? Charlie Munger, this is 2 or 3 years before he died, Charlie Munger attacked Bitcoin. He called it evil, in part because it would begin to undermine the Fed's ability to manage the economy.
Or it could provide market discipline. Or it could tell the world that things need to be fixed.
Bitcoin does not make you nervous.
Bitcoin does not make me nervous. I can hearken back to a dinner I had here in 2011 with someone who is another guest on your show. I won't say his name. I just did Mark Andreessen, who showed me the white paper That was the original white paper. I wish I had understood as clearly as he did how transformative Bitcoin and this new technology would be. Bitcoin doesn't trouble me. I think of it as an important asset that can help inform policymakers when they're doing things right and wrong. It is not a substitute to the dollar. I think it can often be a very good policeman for policy. And if I were to speak more broadly to what did Charlie Munger and others perhaps have in mind, there is a proliferation of securities that go under all sorts of names. Many, if not most of them, are not worth what they might be being traded for. So what did Charlie say, and maybe his pal Warren say? There's the innovators, the imitators, and the incompetents. They're real innovators that are happening in and around that new technology. And what I would try to impart towards businesses and bankers is that the underlying technology that Mark showed me in that white paper, or tried to show me in that white paper, it's just software. It's just the newest, coolest software that will provide us an ability to do things that we could never have done before. Can the software be used for good and evil? Yes, both, like all software. So I don't cast aspersions like that. If there's a final point, it's these technologies are being built here. I don't just mean on Stanford campus. I believe in the United States. And the world's most talented engineers from China and Europe and everywhere, they come to the United States even now to try to build this stuff. And my view is by building it here, that gives us an opportunity to be more productive and create something very special over the next decade.
Interesting. You get all these, like, we watch these things and I study these markets, and sometimes I question my existence of, or bringing kids into this world. It's like,
Right.
I hear politicians on both sides of the aisle come off with stuff, and I'm just like, oh my goodness, like, I hope we're not headed towards nuclear war. But then I see something like this, I was like, it's just like a breath of fresh air. You know what I mean? It was a measured, balanced response to an issue, well before its time, right? Mm-hmm. You pointed out orange tie.
Yeah.
He was wearing an orange tie in that interview. Interesting. Okay. So I want people to understand, like, where this thing is. Like, this is global wealth. This one's a little bit dated. This is like December of last year. So some of these are changed a bit, but it's like, I just want to give people a visual representation of the world, right? I tell people, it's like, it's not that complicated. There's just too many zeros, and there's too many people trying to explain it to you don't understand it. Okay?
Yeah, these kind of charts are really good because it's a great visual representation of what's really going on.
This is the world. There's $300 trillion worth of real estate. There's $137 trillion worth of cash or near cash. Okay, there's $127 trillion worth of bonds. There's less stocks comparatively. The bond market is senior to the stock market, and that there's $110 trillion worth of equities. Okay, precious metals, you can see how outdated this one. It says 16 trillion. It's grown significantly in the last year. Okay, but still, even doubling that, tripling that, you see where that is comparatively. Okay, the gold market has grown larger than the U.S. bond market. Yes, the U.S. government bond market. Yes, that happened this year. But this is what we're talking about, people. Ultimately, it's the allocation of this capital, okay, throughout the world. Real estate, cash, bonds, equities, metals, okay? Metals and commodities. Like, where is that capital going to go, okay? You can see the pressures in real estate. You can see a disproportionate amount of the world's wealth is in real estate. This is why governments are so focused on it, because you have, in Canada, I tell everyone you have 3 layers of government: the federal government, the provincial government, the municipal governments. They all have their hands out. And where's all the wealth? It's in the real estate. Mm-hmm. And they all have an avenue to tax that real estate, multiple avenues to tax that real estate. And they can tax it not just by taxation, by regulation, who you can rent it to, how you can raise the rents, and if you can kick them out if they're not paying the rents. Okay, and so there's multiple ways to attack that real estate, and they're looking at that real estate. Where is this capital going? I just showed you a giant pot of money, a giant $8 trillion pot of money. US dollars, an $8 trillion pot of US dollars. Compared to, in Canada, for example, I wonder if I even have it here. In Canada, it dwarfs the Canadian M2 money supply. Just dwarfs the money in the U.S. money market fund completely dwarfs the Canadian money supply. Okay.
Yeah, I mean their market is multiples larger than ours, like multiples. Like it's massive. And Carney talking big and doing all this stuff to display his Trump derangement syndrome, probably to try and do another election coming up to try and achieve his globalist goal of getting a majority government and being able to do whatever he wants in Canada. But still, like, our economy in Canada is dwarfed by the U.S. U.S. is by far the largest thing, and we need to be trading with the U.S., not fighting them every step of the way.
So we avoided the crazy, modern monetary theorists coming in and just printing everything to infinity and lowering rates to zero. They're not going to try that, right? They're going to lower rates, lower short-term interest rates and maintain the balance sheet. Thank you. Some sort of breath of fresh air. I have something that the gold market and the Bitcoin market like that. No, because they wanted to go to 10,000 tomorrow, right?
Right.
But I don't think you want it to go to 10,000 tomorrow because, imagine you have this nice building and it's next door to another building. It's like you need, you want, and this other building is condemned, like it has to be destroyed. You want a nice controlled demolition. You don't want it to fall over on top of your building. You're still living in the neighborhood. You might not even survive, right? So,
yeah, if gold goes to 10,000, our currency goes to zero. Oh my gosh.
That was not I own gold and I'm watching the gold price go up thinking, oh my goodness, how many rounds of ammo do I have? At some point, it's not about the value of the gold. It's like
the value of the brass.
Oh yeah. This is not great. This is not a good scenario for a stable existence in an economy. Okay, so we got a breath of fresh air. But where is this money coming from? I've just showed you this giant pot of money, $8 trillion. It's an $8 trillion pot of money. Okay, the guy who's in charge of setting the rate on this money has told you he wants to bring it down. Maybe close to zero. He wants to bring it down, okay? So it's not going to be the ultimate bazooka coming in where these things are going to the moon in the next, 24 months. Right? That's not what's happening. But he wants to bring it down. And the capital's going to flee, okay? And you're already looking at, before this started, you were already looking at this here, where people were saying, I don't actually like some of these assets. I'm going into other assets, okay? And, who tweeted that out? Who tweeted this guy? Michael Saylor tweeted that out, right?
You made reference to Bitcoin.
Michael Saylor tweeted that out. And where is some of that capital going? And so you see a lot on the Bitcoin price. You had, really, really tight monetary conditions in the last, you've had it in the last 3 years, really. Like the U.S. M2 money supply hasn't gone, anywhere in 3 years, basically, right? We've only now gotten back to where it was 3 years ago. So there was that pullback. But a lot of people around the world are saying, I didn't want the 3%. A lot of people say, I don't want the 4%, right? I don't want the duration risk of, I don't think lending the U.S. government capital at 4%, watching them print 8% new money over the year long term is great, right? I don't want 3%, right? And I'm, a little bit freaked out of buying NVIDIA at 60 times earnings.
Right.
So there's a lot of, where has that capital been going? And there's downward pressure on the Bitcoin price where it hits these crazy highs because of regulation and Trump coming in, the first pro-Bitcoin president, and, whales cashing out. Yeah, there's whales cashing out. I look at the flows of what's going in ETFs. I also recognize a lot of the whales sell physical Bitcoin and buy ETFs. They still have the exposure. So not all of the flows to ETFs are new money. Some of it are new investors. Some of it whales as they want to buy if you're sitting there in Dubai in a tax-free jurisdiction, you got $100 million worth of Bitcoin. Well, I can sell $10 million and I can buy the ETF and now I can borrow against it.
Right.
Right.
Yeah.
So that's a flow, But the flow that's going into MicroStrategy where, it's no longer him selling equity to buy Bitcoin. It's him selling preferred stocks that are basically bonds, paying a rate. He said, forget it. Forget your investing in real estate and worrying about the taxation at different levels. Forget about getting just 3% on some sort of short-term treasury or money market fund. Forget about, investing in long-term bonds where you get 4% and take this big duration risk. Give it to me, and I'll strip away all the volatility of Bitcoin, and I'll just give you a 10% rate of return. I'm going to buy this asset that I think is going up by 20% year over year, and I'll just give you the 10% fixed rate, and I'll take the risk and ride the volatility train so you don't have to. And what did that result in last year? Before this 8 trillion got unlocked. Before this 8 trillion got unlocked, there was 164 billion Bitcoin, or 164,000 Bitcoin mined last year. 164,000 Bitcoin mined last year, and MicroStrategy purchased 226,000. Just MicroStrategy purchased more Bitcoin than was mined, right? That was last year, okay? This year in the first month, just in January, there's 12,000 Bitcoin mined so far, okay? MicroStrategy has purchased 40,000 Bitcoin already. They've already purchased almost 4 times the new supply of Bitcoin. Almost 4 times the new supply. Now, there's $8 trillion. That's $4 billion. That's $4 billion, right? Billion with a B. I've just told you there's $8 trillion of capital that's sitting there in an instrument that the rate of return is going to near zero. The head of the Federal Reserve has just told you, right? And we're talking about Japan, and maybe they pull their $1 trillion of capital back, right? There's $8 trillion of capital that's going somewhere, right? And so the expectation that Michael Saylor won't be able to raise another $50 billion by the end of the year
should be pretty easy.
$50 billion. We know there's $8 trillion that's sitting. He was raising this before that $8 trillion ever became unlocked, because people were just sitting around looking. It's like, I don't want cash. I don't want the bonds. I don't want the real estate. I don't want the equities. I'm buying STRK. I want my 10% from Michael Saylor. It was already happening before that 8 trillion got unlocked, right? Now there's 8 trillion getting unlocked. There's probably that 8 trillion is going to go to 4 trillion, right? It's going to go somewhere. It's not all going into Bitcoin, right? But I'm saying, like, how little has to go into Bitcoin to maintain that bid? 40 billion.
Yeah, that seems like nothing.
40 billion on 8 trillion. 40 divided by 8,000 people. You know what I mean? Like, just you start doing the math. Like, of course he's gonna, like, I know 40 billion here, and it's like, you can't beat it. It's like, there's a guy sitting there in Saudi Arabia last year who loves video games, who's sitting in his castle, who's just decided, I'm going to spend $50 billion on buying a video game company. That happened last year, people.
I know, right?
$50 billion. It's like, I know it's a lot of money, but in the scheme of things, it's actually, for the people who move, it's not that much money.
Yeah.
So the fraction of money that has to go in, the fraction of money that's basically stranded with no rate of return coming, that has to go in, it was already going in, and now there's another 8 trillion that's going to go out. We're going to find out what assets, but I think after this podcast, I'm going to go and buy another $7,000 worth of MicroStrategy stock for this year at my TFSA, and so that's not my advice for everybody. That's what I'm doing. And I'm going to go buy another ounce of gold here today with the pullback, because that capital's coming out of those, right? I'm going to allocate some quality dividend paying stocks, and that's what I'm going to do, right? And does the volatility bother me? Not at all. Okay, there's no way I'm not one of these people. I'm not contributing anything to that $127 trillion worth of bonds. Like, no, thank you. I'm not deploying capital at 3 or 4% or 5%. Thank you very much. While the governments around the world print money at 8% or more every year, I'm not doing $1. I'm perfectly happy with my net worth going up or down by a Porsche 911 in a month. That's no problem. The last thing I want to do is destroy it by deploying capital at 3 or 4% while they increase the money supply by 8%. Not doing it. Okay?
Absolutely.
And so that's what I'm doing. And I encourage, people, hopefully this helps people like look beyond the headlines of like what is actually going on, right? As opposed to just reading something in the New York Times that doesn't include one number, or in the Edmonton Journal, or on the CBC, or about that. You know what I mean? Like this is what's actually going on in the world. These are the real numbers. You can look them up on the Federal Reserve, or on the Stats Canada, or on the Bank of Canada. They're out there. These are the real numbers, and I hope you make some decisions and learn about what's happening in the world, because this, we have some thoughts that this, we have some normalcy, where we're not getting this crazy run up, which is a little bit, although the crazy run up might have been kind of fun, it's also probably pretty destructive, right? Yeah. So that's what we have. So I think we got some activity there in the chat, right? So
all right, so we got David Grundy in the chat. Is farmland in Ontario a good hedge against inflation, especially if you bought via an active farm corp to benefit from all the tax incentives?
Yeah, I mean, is just parking money in farmland, if you have $10 million to park $1 million in some farmland, is that a bad deal? Probably not. If you have $1 million, and if you have a net worth of less than $1.3 million, right? $1.3 million less, just parking money in just land, I think it's a pretty inefficient use of capital, unless you're generating the rental yield or the business income from that land, right? If you do it for 6 months or a year, but just parking money in land alone, you really have to get lucky on the piece of land, because you're watching them print 8% new money every year. It's like, and if you only get 4, 5, 6, 7% on that appreciation, you've actually lost purchasing power. So it depends on net worth. That some people are just, they're never going to spend what they have, in which case diversification is king, where they're just looking at, how can I not go to zero? I'm starting to look at, not just farmland, I'm looking at cool pieces of artwork. I'm looking at real estate in different countries, right? But if you're not at that point where the increase in net worth is still affecting the way that you live, I think you probably don't want to hold on to vacant land too long, and it should be land that you're either renting or deriving business income from as well.
Yeah, of course. That makes a lot of sense. So assuming gold maintains 11%, it will reach 11 to 14K in 10 years time, 2025, it average 8 to 9%. And we're in a more bullish cycle now. When in doubt, zoom out.
I think that's someone who's been on the boot camp before. That sounds like a lot of boot camp material. For 11% compound annual growth rate. When in doubt, zoom out. That's the boot camp. On the next boot camp, I'm going to test some upper limits of gold and Bitcoin, because there's the gold or Bitcoin that are actually in reserves of the U.S. government, and then there's the gold or Bitcoin that they can actually access. And I think, either on a future podcast or in the next boot camp, we're probably going to do that. So I looked today at 60% of the boot camp tickets, they're already sold. So this thing's not until May. 60% are already sold. So get your ticket, and we'll give you some guidance on that compound annual growth rate, because we saw through the tunnel a little bit in the haze with that recent run up in gold. Like where does that start to come into equilibrium? I think the market is ultimately telling governments eventually. The market will speak before the voters will speak. The market will eventually tell the government that your currency needs to be backed by something.
Yes.
Not next year, but sometime we're going to get some sort of reasonable reserve backing, because there is reserves out there, right? There are reserves that governments could access out there, whether it's ethical or not. We've seen in the boot camp we teach about the history of how they got the gold reserves in the 30s, right? But there's where is that point where these hard assets start to match the money supply? There's a long ways to go before we're there. We've kind of caught a glimpse of it with this recent run up in gold.
Yeah, no, that's great. I think this was a great podcast. Everybody should have learned something from it. Bookmark it, share it with a friend, because if you've got people who are skeptical about what's going on and they've got questions about investing, definitely take a look at this podcast, share it with a friend. Don't forget to like, subscribe, hit the notification bell, leave questions in the comments. And I think we should audit the Fort Knox. Just saying. Where's the gold? Where's the gold?
The gold is there. The big question. Right?
That's it for me, guys. We'll let you research that yourself. Talk to you later. Bye.